Welcome to another session of Talking Trade. I'm Ken Wasylik, Managing Director of EM Wasylik and Associates, an international business development company.
And I'm Sandy Siegel, President of ME Day. I am excited to welcome back our guest today, John Min, a PhD and Chief Economist at Monex USA, which is a global payment and foreign exchange organization. So thanks, John, for coming back to Talking Trade.
Oh, you're welcome. Wow, the time went by so fast.
Yeah.
It did. And I'm sure listeners and myself were interested in hearing what lies ahead for 2026. Before we do that, it's almost a year exactly that we had you on the show in January of 25, and we talked a lot then. The anticipation of what laid ahead with the Trump administration and all of the impending tariffs that we anticipated and what that looked like on the economy and how the Fed might react and so forth. So, you had some great thoughts and insight on that, and I think you made some predictions. So let's talk about that for a minute.
Bring me on the spot.
And
Well, yeah,
you know.
we got the scorecard. We got to get the
Yes.
scorecard going here.
I think that's a great entree looking forward into 2026. But I'd say on balance, you were pretty much on point. Maybe with a little bit of detail that changed. But give me your thoughts on how you did,
Well,
what you
yeah.
anticipated for 25 and how it actually played out.
First of all, I do make a lot of forecasts and predictions and things like that, and it's always a good sign when you get invited back.
That's right.
So as soon as I got your email, I was like, "Oh, I need to go back to what I said," and I managed to find my presentation deck I shared at the MITA, which was the
Yes.
the conference I spoke at, and I went through it, and then I said, "Oh, I was pretty good," because the last year, beginning of the year, a lot of people were thinking recession, and we came out and said no recession, no landing, it's going to be okay. I actually wrote down some of the points I wrote down. I didn't mention the fact that price is going to be stubborn, that going from 3% to 2%, I think I called it the last mile, is going to be really hard. And it turned out to be. Currently, inflation rate is, according to last month's report, 2.7. But
Okay.
it's going to get revised up because we had a government shutdown in November. So government assumed there were no price increases. And then there was delay getting the survey. So they went out surveying prices second half of November when there are a lot of holiday sales. So that number is distorted. So based on my back of the envelope calculation, we're still 2.9, 3 points. So we got that right. The tariffs, that's the area that I got a little fuzzy because based on our past experience with the models and 2018 experience, it will have a greater effect on the US economy. It turned out to be much less. I'd say maybe 40% of what I expected the impact would be. But that has to do with taco trade. You know what that is, right?
Right.
Trump
Yeah.
always
Yeah.
is
Yeah.
out.
Yes.
So
Yeah.
there was a delay, exception, another delay. And then, of course, with the Canada and Mexico, with the USMC still in place, 80 to 90% of their export to US are exempt from these tariffs.
Yeah.
So, and then, of course, big surprise, I thought there would be retaliation
Yeah.
on US tariffs, so that would amplify the effect, but we didn't see that except from China and Canada. But again, Canadian part is minimal. So based on that, much less effect than what I anticipated, but it is raising prices. So there's Harvard Business School has a program. It's kind of neat. They're using AI agents to go out every day, look at 300,000 items on the internet, and they
Okay.
check the prices on a daily basis. And based on that, the prices have increased on those imported goods affected by tariffs, especially the Halloween costumes was crazy. I don't know what's going on there. It just went up. It's about 0.6, 0.7 higher. So if it wasn't for tariffs, I think we may be close to 2%, which is our goal, but we're stuck at 3, so there is an effect. And who's paying for these tariffs? Just the fact that U.S. Treasury is collecting $30 billion a month right now, someone's paying for it.
Right.
Not the Chinese, it's not the Europeans, it's the U.S. businesses who are paying for it, whether they're passing on the tariffs to consumers, according to KPMG survey study that was just done last month, about 50% of the cost is being passed on, and companies are absorbing at their margin. We just don't know how long they could last doing that. If that's the case, we are going to see the full effect of tariffs on prices to consumers in the next 6, 7 months.
I agree. And from the, being on the ground
Oh,
and
yeah,
talking to
that's
importers,
yes.
that's what I've been saying throughout the year as people talked about the, impact on the economy. Like we aren't going to see it till fourth quarter 25 and the beginning of 26
Yeah, that's
because
exactly it.
importers were trying to absorb it. In some cases, they were negotiating with their suppliers, sharing, the tariffs, and they were waiting. No one, the decisions were coming out and the changes to the tariffs so rapidly that they couldn't, immediately pass on the price increase, and everybody was just kind of reacting. So I think now is when we're really going to feel the
And
impact of the
underneath the
tariffs.
hood, I see almost a divided economy to a certain extent. Some people call it K economy. The bigger retailers are able to absorb it better,
Sure.
but because they have the scale, they can negotiate, they can find alternative suppliers. It's the smaller businesses.
Right.
They're really getting hurt because cash flow is very thin anyway. So the limited margin with that. So if you look at the employment data, it's the
Yeah.
large companies are still hiring, but
Mhm.
smaller companies are cutting down employment.
Yes.
But
Yes.
that's a good point, John, because most of our clients, if they sell to a larger organization, even Walmart or some of the big box guys, I mean, they have a 90 to 120 day, sometimes even 360-day advance notice of any price increases,
Right.
right? Right. And so, yes, the supplier is almost forced to absorb any tariffs because it's immediate, but they can't pass it on. And every time there's a line review or a category review, then we start negotiating the pricing, and then it's going to hit in 2026.
It's a longer term, I think, impact.
Right.
Oh, yeah. In addition to
you.
that, if you look at the first quarter GDP data, we actually had a contraction. And that's when everyone used the big R word. Recession is definitely coming. But that was because of huge surge in imports in anticipation of the tariff, front loading it. And that's
Right.
the inventory buildup. And that took about 4 or 5 months to draw it down. So
Right.
now we're beginning to see the effect of tariffs.
Sure.
$64,000 question is whether this increase in price is it just one-time effect,
Right.
and that always going to be lasting. So
Right.
if it lasts, then it turns into inflation because prices are going up. If it's a one-time effect, then it's just step function, and then inflation will stabilize maybe 2.5. But I am in the camp of sticky prices at 3%.
All right. So
Interesting.
we're going to agree you get a B+ for your prediction.
The tariff threw me off.
Last year. So that's
Wow.
a
Well,
great
I can.
segue.
For an
Hey.
economist, B+ is like, woo.
Wow. Well, just wait until January 2027 when we get you back on.
We'll
See.
not have this podcast in next year.
Right. So now I want you to set the stage for 2026. What do you think the macroeconomic outlook is, and based on all the the predictions and the indicators that you're looking at.
Well, if you emphasized the word macroeconomic conditions. I'm very optimistic. I think the GDP growth is going to be north of 2%. To me, 2% is normal rate of growth given the population growth and just average run in productivity. Growth rate should be about 2%. That's the baseline case scenario. But I think we have a shot at 2.5, close to 3% growth. That all comes down to productivity, by the way. But if you just, as say, describe the microeconomic conditions, I'm very concerned because we are growing, but we're not creating jobs. And in fact, I've never seen this type of disconnect between growth rate and the employment numbers because we are growing at a rate that we should be generating 100, 150, 200,000 jobs, but I anticipate we're going to be growing about 40 to 50,000 jobs. A lot had to do with the immigration issue, deportation, all that. But again, it's system-wise for years. If your economy grows, you need more fuel, you need more workers, the labor force. But we're not doing that. So only logical explanation, hopeful one, is there's a huge gain in productivity. But just a few minutes ago, I got the latest productivity number for the last quarter, so the third quarter. It's a 4.9% annualized rate of growth, twice as high as what we were anticipating. And the productivity seems to be accelerating, and that trend has been going on since 2020. Since we got a COVID shutdown, U.S. economy has seen acceleration in productivity. If that's the case, companies can grow, economy can grow with a less number of labor force or the work hours, the labor hours. So that means it's a good sign, except I feel bad for the recent college grads.
Yeah. So is AI, I mean, one of the questions we are going to ask you last year and now this year, we've had another year, is the impact on artificial intelligence or productivity in the economy? Because you see it in almost every segment, no matter where you're going. You were talking about, just gathering data, but you're seeing it even at the auto repair workshop, right? And we're buying a new house, and just the whole inspection of the house is all automated, the whole thing. So is AI playing into this productivity?
So if you're looking for studies, economic studies, peer reviewed, and then verifies there has been a productivity boom due to AI investment, AI usage, you got to wait another 3 to 4 years, right? So right now, I am actively doing research personally because productivity was my PhD dissertation topic back in the day when there was a internet revolution and productivity. So one thing I do know about productivity is very hard to measure because by definition, productivity means economy grew this much and we added this many workers, we added this much investment. Anything that's left over we cannot explain, that's productivity. So that being the case, MIT stunned everyone back in April of last year by saying, based on their research, 90% of the companies that invested heavily in AI has not seen any measurable return. But then I just read a study from the St. Louis Fed that says, yes, it is making a difference at the margin. So I think it's too early. I don't have any peer-reviewed academic studies with the data that has been verified to say it is a game changer. But my tummy is telling me it is because I am getting micro company level data that is making a huge difference at McKinsey, Boston Consulting Group. I mean, they're the ones who are actually reducing the number of associates and replacing with AI agents. And in our company, we're doing the same. Instead of having a BDR, SDRs reaching out to prospecting, we're using Salesforce Einstein AI agent who is systematically all on his own sending, oh, I'm sorry, it's not her. Her name is Ava, by the way. She's amazing. She sends 300 tailored emails to our ideal customer profile prospects, reaching out and following up, working 24/7, trying to set up meetings for our account executives so they're more free to do higher value
Right.
add. So putting it all together, I do expect there is going to be a bump, AI bump productivity that could be 3, 4, 5 years in making. And as a result, if you look at my stock portfolio, I bought into AI narrative about a year ago and has been very good for me. And I expect that will be good for the next 2 to 3 years. So.
Okay.
There's so much money that's getting involved. It's about $500 billion a year. That's already
Yeah.
investment alone. By the way, that's 0.75% bump in GDP just on the investment AI. I hope it's not
Right.
a bubble. That's a serious
Yeah.
question out there, based
Yeah.
on our 2000 experience, but the internet bubble. But I don't think this is a bubble at this point.
So let's go back to the international realm of tariffs. So
Yep.
we've seen the ups, down, sideways headaches that all the importers have had. How do you see 2026 when it comes down to the tariffs?
It is. It is sand in the global trade gearbox, whatever you want to call it. But I am so impressed with the resilience of global economy. I agree with the IMF's forecast that came out in October for this year, which is the global trade will actually grow again this year. Even China, their export to US fell by 25%, but their overall export to the rest of the world exceeded $1 trillion for the first time. And overall, international trade, we expect to be, I don't want to say rosy, but still positive, still growing. Folks are figuring out different ways of doing it. Now,
Right.
interesting for us is that our salespeople, our traders and salespeople are getting a lot of requests for strange currencies like Vietnamese dong, Malaysian ringgits, Indian rupee, Colombian peso. I think that's a reflection of the fact that global supply chain is shifting out of China, going to different places. And we're doing lots of trading. Well, not, I shouldn't say trading, facilitating payments for US companies who are sourcing goods from Vietnam.
Okay.
So
Sure.
is this shift? Obviously, the shift is that the trade itself is not in U.S. dollars, and so is it because of the shift in the trade, or is it because the U.S. dollar's value compared to, let's say, the Vietnamese
So
dong?
we were a little concerned back in April after the Liberation Day, with the shock and awe of the tariff rates going up to 50%, 25%, 125% to China, and all that. There was about a month period of sell America trade. In other words, folks were selling US bonds, US equities. And in the past, that never happened. When you sell bonds, equities went up. When you sold
Right,
equities, bonds went down. There was
right,
always trade-off. But this
yeah, right.
time, bond prices went down, equities went down, dollar went down, suggesting that people are leaving the dollar and the US. They were
Hmm.
pulling it out. So I was like, oh no, my forecast for stronger, resilient dollar is gone. Um, I was concerned about that, but then a month later,
Yeah.
it
Yeah.
came right
Yeah.
back. And
Right.
now I'm tracking the data says money is pouring in to equities. So, which is kind of reaffirming my view that the US company is going to be more productive. The margin is going to hold up. Their earnings is going to be another 12 to 15% growth next year. There will be a strong surge in the stock prices. That's why they're coming in. The bonds, it's tricky. It has come back, but there's not a surge. But that's because I think people are more interested in gold nowadays.
Yeah.
Hmm.
So
Interesting.
how do you think that, so you were right, strong dollar on balance for
Yep.
2025.
B
And I
plus
took it, I took,
plus.
took advantage traveling.
I could be A minus.
Right.
I never got an A.
what's your prediction for 26 based on what you just said? It sounds
Not going
like
to be a
still
stronger
resilient.
dollar. I think it's going to be resilient dollar.
Yeah.
But the game changer is going to be, well, it could happen tomorrow. Supreme Court is supposed to come up with an opinion.
And
They
the tariffs.
didn't specify whether it's going to be reversal of tariffs.
Yes.
I have a friend that works for the White House in my neighborhood, and he assures me tariff will be in place because there's a backup plan by administration.
Yeah.
But we'll
Right.
see how that goes. But the I shouldn't say interesting, more concerning element that I kind of cover at the presentation at Madison next week is the U.S. debt. I thought U.S. debt and the deficit interest payment was going to be much noisier issue for the second half of last year, but it didn't happen. That's because we are collecting $30 billion.
Good. Yeah.
That's like a $300 billion worth of revenue that we're collecting that goes straight to the Treasury.
Yes.
And so I think that's holding the long-term yield down a little bit. It's anchoring it. But what's scary thing is last time, so that was December when Fed cut the interest rates. The short end of the yield curve went down, but the long end went up.
Up, right.
So that tells me that there's folks paying attention, especially the bond vigilantes. They're keeping an eye on it as, okay, if the tariff goes away, inflation's sticky, and interest rate stays high, then interest payment is going to be well above $1 trillion, 1.3. Our physical condition is going to deteriorate in the long run. That's my big concern. But at the end of the day, Monex, we're focused on 6 to 12 months for our clients. So we're not a long-term investment house. We are a trading shop.
Yeah.
So that is like let's worry about it next year.
Right. Well, yeah. John, I could chat about this all day, but unfortunately we're out of time.
It's so interesting.
You're joining us again at the Madison Trade Association on Tuesday the 13th, and again, you did a great insight last year, and looking forward to the same next week. And so,
one comment. I'm thinking my retirement now because my portfolio is there.
Okay.
You know what I found out? As soon as I start thinking about retirement, my predictions are getting bolder.
Okay, well, that's right. There's less at stake at this point.
I know. I know. It's getting bolder.
Well,
my colleagues are like, John, yes, a bold statement. It's like, yeah.
Well, John, as you get older, the filters, you lose those filters, right?
That's dangerous for
an economist, I know. So, just to add to Sandy, so, it's January 13th at the Fluno Center, the Madison International Trade Association. You'll be speaking again. And the program starts at 10:30, I think, this year, a little earlier, so that there's more time to have one-on-one conversations with yourself and others that are attending. So looking forward to seeing you there.
Awesome.
Yes, sir.
John Min, thank you for joining us again on Talking Trade.
You've been listening to Talking Trade with Sandi Siegel and Ken Wasylik, sponsored by the Wisconsin Center for Manufacturing and Productivity, Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategies.